Coming up on Market to Market, millions of Americans get a bump in pay to $15 per hour. The nation's largest grocer adopts a cage-free egg policy. And winter's freeze helps squeeze more profit from the fruit of the vine. Those stories and market analysis with Angie Setzer next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. This is the Friday, April 8 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Stronger auto exports went up against falling oil imports this week as poor stock returns sent Wall Street on a bumpy ride. According to the Commerce Department, the trade gap widened by 2.6% in February, creating a $47 billion gap, the greatest in 6 months. Oil played a part in the equation as crude imports fell to the lowest level in 13 years. Despite Janet Yellen's dovish comments on interest rates last week, notes released this week from the Fed indicate an interest rate increase is still on the table. This news, combined with lower corporate earnings, resulted in volatile trading sessions on Wall Street. A major factor in those company reports are wages. The federal minimum wage is $7.25 per hour. Many employed at this rate have difficulty making ends meet, and some business owners worry an increase will shut them down. A measure on Capitol Hill to raise the minimum wage has failed to gain traction. Tired of waiting for Washington to reach an agreement, legislators in 2 states moved forward on their own. Paul Yeager explains.
The minimum wage in 2 states went up this week, almost simultaneously. Governors in California and New York signed legislation to raise the rate to $15 per hour. Critics in both states contend the increase will eventually force some employers to reduce their overall workforces while adhering to the law. Under the bill signed by Golden State Governor Jerry Brown, the first bump will be 50 cents next year and to $11 in 2018. Hourly $1 raises will come every January 1st until 2022. Smaller businesses with less than 25 workers will have an extra year to comply. After initial wage gains, the state will have an out to suspend the plan if job growth retreats and retail sales tank. And more delays could happen if the state is facing a serious budget crisis. Governor Brown has admitted the legislation is a tough financial hurdle for businesses, but signed the bill anyway.
This is an old idea from the 19th century, from religious leaders, that work is not just an economic equation, but work is part of living in a moral community. And a worker is worthy of his or her hire, and to be worthy means they can support a family. So economically, minimum wages may not make sense, but morally and socially and politically, they make every sense.
A nonpartisan legislative analysis put the cost to taxpayers at $3.6 billion to implement in the government sector alone. The economically diverse state is the world's 8th largest economy. About 2.2 million Californians now earn the minimum wage. And higher pay advocates claim about 6 million of them earn between $10 to $15 per hour. But one university economist estimates the boost could come at the expense of about 5 to 10% of low-skilled workers who will end up getting pink slips. Small businesses are mixed on the impact of the hike.
Yes, I support it. I think it's the right thing to do, and I'm not unhappy about it. I think it's the minimum you can earn to live in a city like San Francisco, and it is probably not enough. But the market won't allow us to go any further, and frankly, we can afford the minimum wage because everybody's going to have to do it. So all of the competition will have to do it. So you can work it into your pricing and it won't be unreasonable because everybody has to do it.
Farm labor is not exempt from the new rule. Owners of one San Joaquin Valley farm that employs about 2,500 workers predicts they'll hire 10% fewer workers because of the higher wage mandate. In New York, the rollout varies from 3 years in New York City to as late as 5 years in other regions. About 2.3 million workers are expected to benefit from the increase in the Empire State. New York Governor Andrew Cuomo cited a former president in his reasoning for signing the bill into law.
When FDR proposed the minimum wage, you know what he said? If you work full time, you should be paid a wage that provides a decent living. That's what FDR said, a decent living. And the truth is, at $9 an hour, you can't afford to raise a family in New York. And that's why we're going to raise it to $15 an hour to restore fairness and decency.
For Market to Market, I'm Paul Yeager.
In recent years, animal rights groups have launched campaigns to change how animals used for food are treated, and corporations have listened. An example is McDonald's. 4 years ago, company officials told suppliers they would no longer purchase pork from farmers using gestation stalls. And last year, the fast food giant pledged to use only cage-free eggs in its U.S. and Canadian stores. This week, another major supermarket chain announced how it will source its eggs in the future. Peter Tubbs reports.
Walmart stores, the nation's largest retailer of groceries, announced Tuesday they will switch to selling only cage-free eggs by 2025. Walmart joins Target, Costco, and McDonald's in transitioning away from caged laying operations and towards production methods consumers perceive as being more humane. Walmart's announcement only accelerates the cage-free trend. With a 25% share of the U.S. grocery market, its purchasing decisions set the standard for much of the grocery industry. In 2015, Walmart urged its meat producers to reduce the amount of antibiotics used in the raising of farm animals. Animal welfare groups applauded the announcement. The era of confining hens in cages is officially sunsetting. The cage-free switch is part of a greater consumer movement to know more about where the food on a household's plate comes from and the methods used to go from field to plate. Techniques that ensured a cheap, consistent food supply are falling out of favor. The egg-laying industry is just returning to full production after the avian flu epidemic forced the culling of over 42 million chickens in 2015. 10% of the nation's laying stock was lost, sending egg prices soaring 30% between May and August. The USDA estimates production has returned to pre-epidemic levels, climbing to 8.4 billion dozen annually. In a study conducted by the University of California, Davis, the change to cage-free methods will be slow and expensive for producers. Caged chickens are unable to adapt to an uncaged environment and will have to be replaced with new stock. The population density of houses will go down as cage-free systems can only hold 2/3 as many birds. Mortality often rises in cage-free systems, and production costs can potentially be 13 to 36% higher depending on the system that is utilized. The study estimates added production costs will result in an increase in retail prices from 15 to 40 cents per dozen. Whether consumers will pay the freight for more expensive production methods remains to be seen. From Market to Market, I'm Peter Tubbs.
A winter freeze can be devastating for some crops. For growers of fruits and vegetables, an early frost can mean the end of the season and a source of income. However, as producer Josh Bittner discovered, the frosty touch of Old Man Winter doesn't mean the end of the line for the fruit of the vine.
This year's weather seesaw pushed back harvest for northeastern vintners who leave some grapes to freeze on the vine and eke out sweeter returns.
When we press the frozen grapes, we get this incredibly intense, complex juice, but only a small amount.
Upstate New York's Finger Lakes region is one of the few wine-growing areas in the nation with the wintry mix needed to make ice wine. However, later than usual harvests, like January's month-behind-schedule haul, can lead to smaller yields. But rolling the dice against weather and the threat of hungry wildlife can pay off.
We have a range of flavors when we press the ice wine. It's going to be very complex. We have raisiny, honey, plummy flavors and good crisp acidity.
The beverage is a staple among Canadian wine sellers, but it's a niche market in the U.S., where bottles can sell for $30 or more. According to the Canadian Vintners Association, nearly $20 million in ice wine was exported from the True North in 2014. But domestic production numbers are difficult to come by. USDA officials conclude ice wine's viticultural and economic risks and rewards still need to be quantified.
We have a moderate climate with a lake effect all around us.
Vermont's Snow Farm Vineyard has found their location. Nestled between mountain ranges on an island in the middle of Lake Champlain, conducive to grapes grown for the sweet libation.
So that means in the fall, we don't have a frost till about approximately 1 month after the mainland. And then similarly in the springtime, as you can see on the lake right now, we have our ice surrounding us, so that keeps us cool, and the grapes like that. These French hybrids really like this climate.
Developed in the 1930s, winter-hardy Vidal Blanc has become a go-to grape for ice wine production.
Up here, you have the good buds.
We're out in the vineyard pruning. The spring has finally come. It's been a long winter.
And winemakers look forward to continued market growth of the distinct dessert drink. For Market to Market, I'm Josh Bittner.
Next, the Market to Market report.
Dry South American weather and increased estimates for the Brazilian harvest made for mixed commodity markets. For the week, the May wheat contract lost 15 cents, while the nearby corn contract moved 8 cents higher. Buyers focusing on southern markets and the potential for Brazil to outproduce the U.S. farmers by up to 50% kept the May contract nearly even with last week. May meal followed the tepid trend, rising $1.40 per ton. In the softs, the May cotton contract gained 87 cents per hundredweight. Over in the dairy parlor, May Class 3 milk futures lost 27 cents. In the livestock sector, the June cattle contract rose 45 cents. May feeders were off $1.85, and the April lean hog contract increased $1.23. In the currency markets, the U.S. dollar index lost 37 points. The May crude oil contract moved $2.93 per barrel higher. COMEX gold added $20.30 per ounce, and the Goldman Sachs Commodity Index gained just over 10 points to settle at 326.50. Here now to lend us her insight on these and other trends is one of our regular market analysts, Angie Setzer. Angie, welcome back.
Thanks for having me.
Well, we are excited to have you. I want to start this by talking about the dollar index. We've seen some weakness here prevail over the last couple weeks. Are we going to continue to catch a tailwind here in the commodity world with a weaker dollar?
We hope so. We've seen corn exports really catch up or get to where, at one point in time we were 26% behind a year ago. Now we're about 14. The last couple days we've seen some export flash sales announced on the corn side. So we are seeing what we need to there. The major question, of course, is does the trend in the dollar continue? We've heard some talk out of Yellen this week that perhaps we would look at the rate increases are back on the table, a little bit more hawkish stance. We've seen some talk out of Japan. The finance minister in Japan say, their currency has strengthened significantly here recently with some stimulus and other approaches that they've taken. He's now said, hey, we're going to cool it on that side if that's what's going to happen with our currency, because of course your economy struggles to recover if your currency strengthens because you can't rely on exports. So I think we're going to have a lot of tug of war back and forth. You have one side where they're bullish the dollar. They think it's going to strengthen and put new highs in place. You have others that think it'll continue to weaken. I hate to be a broken record and say we'll probably be range bound. But it seems like at this point in time, with all of the uncertainties that we have globally, from an economic standpoint and things of that nature, that if Yellen, if the Fed comes out and takes a dovish stance, we're not going to raise rates, then yeah, we'll probably see the dollar back off. If she comes out and takes a hawkish stance that, oh, we're doing just fine, we're going to raise these rates, then you'll see the dollar strengthen. So we'll probably have a lot of back and forth through the summer, especially with the election and the uncertainty that's coming out of that.
You bet. But Chairwoman Yellen sitting in the driver's seat.
Yeah.
In the currency markets,
yeah.
so to speak.
Yep, and we're really not sure if she has the car in forward or reverse at this point in time. And to be honest, with all due respect, I'm not really sure that they know at this point in time what they need to do. From a global standpoint, we have a lot of economic uncertainty, issues in Europe, issues in Japan, issues in China. China's the 300-pound gorilla in the room. Yep. And then we have the same thing in the U.S. where one aspect of the economy is doing fine or we see good signs. And then we turn around and wonder, what you're going to see take place with the crude producers, the energy markets.
All commodities as a whole.
Exactly. And so that could have a big influence on the back and forth.
It could. And as we're talking commodities as a whole, wheat market doit pretty substantially this week, 15 cents on the downside. Where do we go next week?
Well, it depends. It really does right now. We are back into the weather market. The one thing with wheat is we do have a weight. Wheat has an anchor on it that is record global stocks, huge U.S. stocks, and we had the confirmation of that in the March 31st stocks report. The biggest gain in stocks are in your hard red wheat areas, both your spring wheat and your southern plains. In the southern plains, basically, we have, going into new crop, about 40% of our needs covered by leftover old crop stocks. So yes, a production issue could be a concern. A production issue could introduce a bullish twist to the market, i.e. What we thought would be extraordinarily burdensome stocks are only slightly burdensome. Neutral.
Trying to find that silver lining.
One of those things where neutral is not necessarily bearish, but not bullish. But we had some rain come into the forecast in the southern plains this weekend. The midday weather models on Friday kind of pulled that out. So the million-dollar question now is, do they get the rain? If they do, does it matter? There are some extraordinarily dry conditions out there. Now, the USDA crop ratings don't necessarily indicate that.
Yes.
So the million-dollar question, of course, is do we see some crop ratings start to deteriorate in the upcoming crop progress reports? And do we see any sort of pattern shift to kind of reintroduce some of that more moisture to help give that crop a finishing kick?
Okay. All right. Now, as we talk about the soybean, or excuse me, let's talk corn. What am I thinking?
Yeah.
Let's talk corn next. We've got a bullish story there. We're up 8 cents here in the old crop corn market. We're rallying off big stocks, big acres.
Yeah.
What does that tell you?
Well, the stocks number, to me, wasn't big. Stocks numbers, really, when it comes down to it, in my opinion, what gives you a big or a small stocks number indication is if it's well above expectations or if it's in line with expectations or below. The fact that the stocks number came in right in line with expectations shows that we are using as much as we've anticipated, perhaps even more so in the sense that the exports have dragged. So, when it comes down to it, in my opinion, I think there's an argument that you could say we're using maybe some additional corn for ethanol.
Yeah, grind has been very strong.
Grind has been extraordinarily strong. Perhaps some additional corn for feed. And the export side of things, those stocks, even if they've been committed, haven't necessarily been shipped. So to me, I don't see the stocks number as overwhelmingly bearish.
Okay.
Acreage number, the acreage number, I kept hitting refresh thinking I was looking at a report from 2012-13 timeframe. That was negative. However, I think that the market itself is looking at that number and saying, okay, every survey that we had prior that was private, every indication that we had prior indicated that we were going to be more in that 90, 91 million acre range, maybe even up to 92. 92 was the number I had in the back of my mind as a bearish surprise. 93.6 seems a little crazy uncle to me.
Okay, and that kind of leads us right into our question from Drew in Montezuma on Twitter. He's asking, with that acreage number we've seen and with corn bouncing, have we seen our low on this D16 corn?
You could say that in the short term.
Okay.
I never like to call a low in March or April, because we could see a low established in October off that Deese contract. At this point in time, I believe from a market standpoint, we have established the low end of where trade feels comfortable extending it.
Okay.
Now, if we see record planting, if planting kicks into gear over the next 2 weeks, and conditions are decent and the crop goes in nicely, then that 93.6 may not be as crazy, Uncle, as what I think. And the market itself could go lower.
Gotcha.
Now, if the dry conditions stay in place and we turn hot and dry into summer, then we're swinging back. But unfortunately, right now it's going to be all weather.
Sure.
And the market or the farmer or Mother Nature is going to have to prove that 93.6 is a little tall.
Okay. Well, now let's talk soybeans. Incredible rally. I
Yeah.
mean, a mind-blowing old crop and new crop rally over the past 8 weeks. Are you selling old crop up in here? Are we
Yes.
toppy?
Yeah, well, I am a seller of old crop in this level. I do think the stocks numbers that we saw indicate that there are relatively decent, reasonable supplies of soybeans out there in the world, or in the U.S. especially, and with Brazil and Argentina harvesting in the world. To me, I would be an active seller, especially if you're sitting on old crop stocks and need cash flow.
Right.
I get a lot of guys, well, the corn market's down, I need cash flow. Well, you have beans in the bin that are worth, anywhere from $8.50 to $9, or maybe even better, depending on what your local market looks like. Soybeans, to me, after last week's report, I was very confident in the fact that on the corn side, those were probably the most bearish. That was going to be some of the most bearish sentiment we were going to see towards corn until we prove that otherwise. On beans, to me, I think we're at the opposite, where we're in the most bullish sentiment that we could potentially see without a production issue.
So how aggressive are you on making new crop sales?
New crop sales, we've been relatively aggressive, 25 to 30% at this point in time of expected production. If you are anticipating swapping over and increasing your acres,
from
corn to beans or anything to beans, definitely look at remembering that increase in production and getting in and selling. It all comes back down to your local, your own situation. I can sit here and say you should be selling, and you could sit there and say I can't make money at this. But you've got to be aware of your ability to withstand risk, your ability of having your risk managed, because there is a great potential there that we could see these soybean acres increase as we go forward, and really kind of put a wet blanket over the market.
Right. On top of big South American crops, big North American crop.
And then you have China discussing cutting some corn production and increasing their soybean production. It doesn't look like that'll necessarily really ratchet down their demand. But the storyline always gets more tread in when it comes to China than the actual result.
Right. Now, you mentioned not being able to make money. That moves us right into this live cattle market. We've seen producer break-evens. The losses are narrowing.
Yeah.
But we're still not seeing a lot of black ink for feedlot producers. Fat cattle prices, are we going to see any more rally in this spring?
I would like to think we will. And it comes back down to the hope side. I don't want to sit here and say, well, I hope so, because that doesn't do you any good. Hope does not pay the bills. When it really comes down to it, you've got to keep in mind where your break even is. Be realistic about it. You cannot hold. It's not like corn. You can't wait until July.
Can't put a steer in the bin.
Exactly. As much as you would love to, you really can't. And then when it comes down to if our weights start to increase again, we're back in the same situation. So exports have been good from what I've been seeing. I think we'll see a continuation of hopefully good exports, barring any sort of real currency shift there. But when it comes down to it, are we going to see a new high put in place? I struggle, just because I think we have a reasonable supply of beef, but your cash market is going to be the driver, your local market structure. So you're seeing some very wide swings between what's being offered in one place versus the next. I'm hearing stories of cattle being moved out of one state into another, and everyone's like, that's very bullish. And it is for that market.
Right.
But you have to keep in mind what your local structure looks like just with grains, and also what your limitations are. and then be smart about what your replacement stock looks like.
And that's the next question. We've got feeder cattle on a break here.
Yeah.
Is that a break that's going to continue as more calves come online in the short term?
Well, I think so in the short term because your supply is going to increase. Of course, we're at that point where availability is increasing. And on top of that, with the loss and the feedlot side, not everyone's running out to buy these calves. So we've got 1 year here where the high feeder costs have encouraged significant increases in breeding. We saw heifer retention increase significantly. We've seen all of that to where our supply side on the feeder cattle should continue to increase to where you can see a break. But also keep in mind that you don't get crazy, that you don't go out assuming that your feeder are always going to be cheaper and that your fats are going to get more expensive. You cannot assume, just as in row crops, you can't assume that the market's going to continue. So just make sure that if you are going out and betting on being able to sell your fats at a higher price and breaking even, that you're doing something to kind of lock in that.
Managing that risk.
Yes, exactly.
Risk management, as we take a look at this lean hog market, great opportunity in your mind to make some sales up in here at these price levels?
I think so. It was just 6 months ago we were talking about how we needed to put new lows in place.
Yeah.
So I think when it comes down to it, supply-wise, pretty good. Margins are getting back into the black or have been here recently. I'm not going to sit here and call that the top is in or anything like that. But if you can lock in black ink and do something with it, you definitely want to look at doing it. And then just as with anything else, protect your risk to the downside and to the upside. We're likely to see swings. I think we're going to continue in the range bound sort of back and forth type trade.
Mid 70s to low 70s?
Yeah, I think so.
Okay.
I really, like I said, 6 months ago, I was arguing the fact that I didn't think we needed to go. We were talking about the 2000s again, where it was
going back to 98.
Going back to when everything was horrible and no one wanted a hog. So.
And we're not going back there, in your opinion, with hope?
Yeah, not anytime
Okay.
too soon yet.
All right. Well, Angie Setzer, thanks so much for joining us.
Thank you. Yeah.
That wraps up the broadcast portion of Market to Market, but Angie and I will keep the market discussion going and answer more of your questions during Market Plus, available on our website. While you're there, check out Market to Market Classroom. It's a place where students of all ages can find stories on the business, technology, and science of agriculture. And join us again next week when we'll explore how the seeds of legal action in one Midwestern watershed are germinating in rural and urban areas. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com.